Welcome back to our series on basic finance. Today we're going to be doing some problem solving relating to financial statements. How this is going to work is we have a financial statements toolbox. These are all the equations that we're going to need for solving these math problems. The best way to use this video to help yourself learn is you're going to want to set these equations off to the side somewhere, maybe write them down, take a screenshot, and then before I begin to solve a problem, try to solve it yourself using the toolbox. Try to identify the pieces that we're using. Next thing, you want to practice these problems. These are often seen on homeworks or tests, so make sure that you're taking some time to practice it. If you do the problem yourself and you get it wrong, it's okay, just rework it. Watch how I do it and rework it. If you get it right, try to redo the problem. See if you can recreate it, because ultimately being able to recreate the homework problems you do on a test is going to help you do better on that test. Let's get started by looking at what is in our toolbox. So first of all, we've got our assets equals liability plus equity. That's our balance sheet equation, our accounting equation. Pretty simple. Income equals revenues minus expenses. Another very simple thing. We've got cash flow from assets. It's going to be our cash flow to creditors plus our cash flow to stockholders. What this means is cash flow from assets is the cash we are generating from our assets. Cash flow to creditors is the cash that we are giving to people who have loaned us money or given us products on credit or with the expectation that we pay later. And the cash flow to stockholders is the money that we are paying our stockholders. This is usually through dividends. We have another equation that can give us cash flow from assets. That's our operating cash flow, so the money that we make from our regular operations, minus net capital spending, this is what we invest in a year, and minus the change in net working capital, so the difference in net working capital over the course of a year. So we start the year with a certain amount of money in net working capital, and we end the year with a different amount of money in net working capital. The difference between those two is our change in net working capital. We have an equation for operating cash flow. We have this thing called earnings before interest and taxes. We'll see that later on, but basically what it is it's just another way of saying our income, except we don't include interest and taxes. Plus depreciation minus taxes. These will usually be given in the problems, or there will be a way to find it in the problem. We have net capital spending. It's our ending net fixed assets minus our beginning next fixed assets plus our depreciation. That's everything we spend on assets. Change in net working capital, we talked about that. Ending net working capital minus beginning net working capital. Cash flow to creditors. The interest paid, so that's the money that we pay to use debt, minus net new borrowings. So that's anything we get from any new loans we take on throughout the year, things like that. Cash flow to stockholders. Dividends paid minus net new equity raised. Net new equity raised is any new stocks we sell. For instance, we might put out more percentage of our company. We might sell it off as stocks, and all that money would be net new equity raised. We have our net working capital equation, which is current assets minus current liabilities. Let's get started with some problem solving. All right, looking at this first problem here, we've got company X has $3,000 in current assets, $20,000 in net fixed assets, $4,000 in current liabilities, and $8,000 in long-term debt. We want to know what shareholders' equity is and how much is net working capital. When I start these problems, the first thing I want to do is I want to identify what I'm given. So I'm gonna highlight that in yellow. So we're given current assets. Actually, let's see. Yeah, we're given current assets. We're given net fixed assets. We're given current liabilities. And we're given long-term debt. And then in a different color, I want to highlight what we want. So what we want is shareholder equity and net working capital. This is going to be a really good strategy to use when going through these problems, especially on a test, because if I know what I have and I know what I want, then I can just go to my toolbox that I'm given for any lesson and I can identify the pieces. So we want shareholder equity, well, and we've got assets and liabilities. So this has our assets, liabilities, and equity in it, and we want net working capital, which has current assets and current liabilities in it. So now we know what pieces we need to use and where we need to put them. All right, let's get started with our shareholders' equity. We know that assets equals liabilities plus equity. We want to figure out our total assets that we're given. So we have $3,000 in current assets plus $20,000 in fixed assets. So we're going to have $23,000 in total assets. Let's look at our liabilities. We have $4,000 in current liabilities and $8,000 in long-term debt, which is also just long-term liabilities. Anytime you see debt, think liability. Anytime you see asset, think asset, or maybe equipment, think asset. We're going to have $4,000 plus $8,000 is $12,000 in total liabilities. So now we just plug those into our equation. We should be able to find equity. So we have $23,000 in assets. That's going to equal $12,000 in liabilities plus our equity. We're going to subtract $12,000 from both sides. And we should get our equity is equal to $11,000. So that means if we were to sell all the assets we had and we were to sell or pay off all the liabilities we had, the people who own the company would have $11,000 when all is said and done. Now we want to find net working capital. So our equation for net working capital is current assets minus current liabilities. So let's see, we got $3,000 in current assets, and we have $4,000 in current liabilities. That's going to give us a net working capital of negative $1,000. What this means when we have a negative net working capital is that we're going to have $1,000 of cash come out of our account for the whole year. So we're going to end the year with $1,000 less in cash than we started. Not always a bad thing, especially if we're paying off debt. We have to interpret it however we're given, based on the problem we're given. But negative net working capital means cash is coming out. Positive net working capital means cash is coming in. And that gives us our answers for the net working capital and the shareholders' equity. All right, we have our next problem. Company X brings in $550,000 in sales, has $325,000 in expenses, has a depreciation expense of $40,000, has an interest expense of $15,000, and the tax rate is 21%. What is net income? And then if Company X pays $100,000 in dividends, then what is the addition to retained earnings? Let's see. So we are given sales, expenses, depreciation, interest, our tax rate, and we want net income and the addition to retained earnings when we're given the dividends that we pay. Well, if we looked at our toolbox, what we'll see is that we have revenues and we have expenses, and we should have everything we need to find the net income and the addition to retained earnings. So let's start with our earnings before interest and taxes. What that's going to be our revenues minus our expenses minus our depreciation, which is going to be $550,000 minus $325,000 minus $40,000, which is going to be, let's see, $185,000. And this represents our earnings before interest and taxes. What we're going to do is we're going to take that and we're going to subtract the interest. So now we're going to subtract $15,000. And that's going to leave us with $170,000. This is going to be called our earnings before taxes. Now, depreciation and interest are not taxable. So what the government does is they say, okay, you can subtract whatever you paid in interest and whatever you paid in depreciation from your total income so that we're not going to tax you on that. Now, there's actually not any cash coming out of our account when it comes to depreciation, but we can still get some tax benefits from it. So we're going to take the $170,000, and we're going to multiply it by our tax rate. This is our taxable income, the $170,000. So times 0.21, and that means we're going to get a total taxes of $35,700. This is the amount we're going to pay in taxes. Using all this, we can now find our net income. So what we're going to do is we're going to take our net income equals what we make, so $550,000 in sales, minus our expenses, so minus $325,000 for our regular expenses, minus our depreciation, minus our interest that we paid, and then minus the taxes that we pay at the end. So all of these, we subtract them all. We should get a net income of $134,000. Sorry, $134,300. And that would be our answer for our net income. Now we want to look at the addition to retained earnings. We have another equation for that. It's not commonly used, so it's not in our toolbox, but it's going to be our net income minus our dividends. If you've had an accounting course, you've probably seen that, and that's where it's going to be used more. So it's not too important here, but we've got $134,300 minus we pay $100,000 in dividends, and that's going to give us an addition to retained earnings of $34,300. And these are our two answers. We have an addition to retained earnings of $34,300 and a net income of $134,300. So what this means is, from our normal business expense, or from our normal business operations, we should make $134,300. Now, we have shareholders that own part of our company, and we pay them dividends as part of their ownership of the company. So after we pay all of our dividends and all of our shareholders, we get to keep $34,300 in retained earnings. We retain it. And that's the solution to this problem. The next problem is a continuation of the last one. And in this case, we are given the shares of stock outstanding we have, and we want to know the earnings per share and the dividends per share. Anytime you see the word per, that's going to mean we're dividing. So we have 40,000 shares of stock. Earnings per share is just our net income divided by the shares outstanding. Dividends per share is pretty similar. It's going to be our dividends over the shares outstanding. So we've got a net income of $134,300, and we've got 40,000 shares outstanding. If we divide that, that's going to give us an earnings per share of about $3.36. If we do dividends per share, we're going to do 100,000 because that's what we paid in dividends over 40,000 shares. And we're going to get a dividend of $2.50 per share. So if I own 10 shares of stock, I'm going to get $25. This next question, we are given our revenue, or in this case, sales. We have a cost. We have depreciation, interest, and taxes. And we want to know what our operating cash flow is. We have an equation for operating cash flow. We'll shorten it to OCF. Operating cash flow is our earnings before interest and taxes plus our depreciation and we're going to subtract our taxes. Okay, let's start off by finding our earnings before interest and taxes. Well, that's going to be our revenue minus our expenses minus our depreciation. We're going to get $1,500. Next, we're going to try to find our taxes. So we're going to take our $1,500. We paid $1,000 in interest. So our taxable income is now $500. Remember, this is our EBT, earnings before taxes. We're going to take that 500. This is going to be our taxes. 500 times 21%. 21% is actually the national tax rate for corporations. So that's what you'll see a lot, is somewhere around there. And if we take 500 times 21%, we're going to get $105 that we pay in taxes. 105. All right, so now we've got our earnings before interest and taxes. We have our depreciation given in the problem, and we found how much we pay in taxes. So now we should be able to find our operating cash flow by putting it all together. So we've got operating cash flow is going to equal $1,500 in earnings before interest and taxes. We're going to add our depreciation of $1,000, and we're going to subtract $105 in taxes. When we total all that up, we should get an operating cash flow of $2,395. Now, if we kind of break this equation down, what's happening is we want to figure out how much cash is coming out of our business as a result of our operations. Depreciation is an expense, but no cash is actually coming out of our account. Our assets are just losing value. So that's why we're adding depreciation back in this equation. In this next question, we are given, let's see, we have Company X had net fixed assets of $200,000 at the start of 2022, net fixed assets of $450,000 at the start of 2023, and a depreciation expense of $50,500 in 2023. What was the net capital spending for 2023? So we're given net fixed assets in 2022, and we're given net fixed assets in 2023, a depreciation expense, and we want to find the net capital spending for 2023. Now, here's what we have happening here. The net fixed assets in 2022 are our beginning net fixed assets. The beginning or the start of 2023 is also the end of 2022. So that's going to be our ending net fixed assets. We have an equation for net capital spending, and that is going to be net capital spending is going to equal ending net fixed assets minus beginning net fixed assets plus our depreciation. So let's see, we've got an ending net fixed assets of $450,000, a beginning net fixed assets of $200,000, and a depreciation expense of $50,500, which is going to give us, if we total all this up, $300,500 in net capital spending. And that's our answer. All right, this next question, in 2023, current assets were $2,340 and current liabilities were $1,470. In 2024, current assets were $3,640 and current liabilities were $2,030. What was the 2024 change in net working capital? Let's see what we've got. We've got 2023 current assets and 2023 current liabilities. We got 2024 current assets and 2024 current liabilities. We want to know the 2024 change in net working capital. The change in net working capital is going to be our ending net working capital minus our beginning net working capital. So let's just write this out. Sometimes you'll see a little triangle, sometimes called a delta. That's going to represent the change in net working capital. It's going to be ending net working capital minus beginning net working capital. The ending net working capital is going to be our 2024, and the beginning is going to be our 2023. So let's look at that. We also have a net working capital equation of current assets minus current liabilities. So we've got 2023 right here, and that's going to be 2,340 minus 1,470. That's going to give us a net working capital in 2023 of, let's see, $870. Oops. In 2024, we're going to have current assets of 3,640. We're going to subtract current liabilities of 2,030. And that's going to give us a net working capital in 2024 of $1,610. To find our change in net working capital, we're going to subtract them. So it's going to be, our ending is the $1,610 minus the beginning $870. And we find that our change in net working capital was $740. This is our answer. What this means is that compared to last year, we will generate $740 more in cash because we have a lot more in current assets than we do in current liabilities. All right, this next problem says long-term debt was $1.4 million in 2023 and $1.7 million in 2024. 2024 had an interest expense of $170,000. What was the cash flow to creditors in 2024? So we're given long-term debt in 2023, and we have a long-term debt in 2024. We have an interest expense, and what we want to find is the cash flow to creditors. We have an equation for cash flow to creditors. We're going to call cash flow to creditors CFC. That's going to be equal to interest minus our net new borrowing. We're given interest in the problem. Let's find our net new borrowing. So we had an initial borrowing of $1.4 million. We had an ending borrowing of $1.7 million. So we started with a long-term debt of $1.4 million, and the long-term debt increased to $1.7 million, which means we borrowed more money. So we ended with $1.7 million. We're going to subtract $1.4 million. We're going to have a net new borrowing of $300,000. So we borrowed $300,000 more this year. We paid an interest expense of $170,000. So let's put all of our pieces into our equation. So we've got our cash flow to creditors equals $170,000 minus $300,000. That means our cash flow to creditors is negative $130,000. And this is our answer right here. Now, what this means is that in the year 2024, we received more money from our creditors than what we paid them. If we see a negative cash flow to creditors, that means we're getting a lot more money from people who are giving us loans than what we are paying them in interest and paying off our debt. All right, this next problem says 2023 has $700,000 in common stock and $4.5 million in paid-in surplus. 2024 has $850,000 in common stock and $5.25 million in paid-in surplus. The company paid out $630,000 in cash dividends during 2024. What was the cash flow to stockholders in 2024? So common stock is the stock that is owned by other people, and the paid-in surplus is what people are investing. So we're given common stock, paid-in surplus, and then another common stock, and another paid in surplus. We're also given a cash dividend. We want to find cash flow to stockholders, and we have an equation for that. So our equation is cash flow to stockholders, we're going to abbreviate it CFS, is going to be equal to the dividends we pay minus net new equity. Now this looks pretty similar to the cash flow to creditors, but instead of dividends we had interest, and instead of net new equity we had net new borrowing. So these are two equations that represent how companies or businesses can raise money. So we can raise money by taking on debt, or we can raise money by getting investors to give us cash in exchange for part of the company. This is the investor side of things. So let's see. We're given dividends. We need to find net new equity in the problem. To do that, we're going to get I'll abbreviate this NNE. It's going to be the difference in our common stock plus the difference in our paid in surplus. So work that out. So we're going to do 850,000 minus 700,000 plus, 5.25 million minus 4.5 million. If we work this out, we should get $850,000 minus 700,000 is $150,000. Let's see. 150,000 plus 5.25 million minus 4.5 million is, what is that? $750,000? $150,000 plus $750,000 is $900,000 in net new borrowing. Net new equity, not net new borrowing. If we put those into our equation, we have dividends of $630,000 minus $900,000. And that's going to give us a cash flow to stockholders of negative $270,000. A negative cash flow to stockholders means that we raised more money from stockholders investing in us than we did paying our stockholders in dividends. And this is our final answer right here. This next problem says, given the last two problems, if 2024's net capital spending was $1.1 million and net working capital went down $50,000, then what was the operating cash flow for 2024? In this case, we're given what we're given in the last two problems, which was cash flow to stockholders and cash flow to creditors. We're given a net capital spending, and we're giving our change in net working capital. We want to know what the operating cash flow was. In this case, we need to combine two equations to find our operating cash flow. Let's go back up to our toolbox and see what we're dealing with. So we're looking at our toolbox, and we were given our cash flow to creditors. We have our cash flow to stockholders. We have a net capital spending, and we have a change in net working capital. There is an equation that uses all of these together, and it's this one. So this one is our cash flow from assets. It uses our net capital spending, and it uses our change in net working capital. What we don't have is operating cash flow, We don't have our cash flow from assets, but we can find our cash flow from assets by adding these two together, which are already given. So we've got this right here. We're going to get a number for this right here. And then we should have 3 numbers that we know and 1 that we don't, and that should allow us to find our operating cash flow. So let's see how this works out. We have a cash flow to creditors of negative $130,000. And a cash flow to stockholders or shareholders of negative $270,000. What we want to find is our cash flow from assets, which is going to be our cash flow to creditors plus our cash flow to stockholders. We're going to add these two together. Negative $130,000. We're adding a negative, which means we're subtracting it. Negative $270,000. That's going to combine to give us negative $400,000. And that's our cash flow from assets. Now we have another equation, which represents our cash flow from assets. So it's going to be cash flow from assets equals our operating cash flow minus our net capital spending minus our change in net working capital. Well, we have our cash flow from assets. That's going to be negative $400,000. We don't have our operating cash flow. That's what we want. We have a net capital spending, which is $1.1 million. $1,100,000. We have a change in net working capital, and it says that it went down $50,000. So that's going to be a negative $50,000. If we combine all these, we should get negative $400,000 equals operating cash flow minus $1,100,000 plus $50,000. That's going to be $1,050,000. Next thing we're going to do is we're going to add this to both sides. And we're going to get a final operating cash flow that is equal to $650,000. And that's our final answer. This last problem is going to combine everything we've learned so far. We're going to use a lot of different equations. And this last problem really represents how we can use income statements to learn about a company or to know how they function. So we're given all the information from their 2023 income statement. So if we were to look at another company's income statement, we would be able to repeat this to find their other the values that we want to measure. So we are given sales, costs, other expenses, depreciation, interest. Our taxes is already worked out for us, which is nice. Our dividends. We're given new equity. We're given long-term debt that we paid off. And what we want is a lot of different things. We want operating cash flow to creditors, cash flow to stockholders. We have a second part of this problem, and it says if net fixed assets increased by $20,000. So we have the change in our net fixed assets. We want to find the addition to net working capital. Let's start with our operating cash flow. So we've got operating cash flow equals earnings before interest and taxes plus depreciation minus taxes. All right, so our depreciation is given in the problem and our taxes is given in the problem. Let's find the earnings before interest and taxes. So we've got sales of $156,000. We're going to subtract costs of $82,000. We're going to subtract other expenses. And we're going to subtract our depreciation, which is $9,000. This is going to come to a total of $59,425. So now we can find our operating cash flow. That's going to be $59,425 plus the $9,000 in depreciation minus our taxes, which is $27,600. We'll get an operating cash flow when we total this together of $40,825. We'll next move on to cash flow to creditors. Pretty simple equation for this. We've got our cash flow to creditors equals interest minus net new borrowing Now, in this case, we paid $13,800 in interest, and we didn't borrow any new money. Instead, we actually paid off some money. So we're going to subtract the money that we paid off, which is $8,725. We're subtracting a negative number, so we're actually going to add these two together, and that comes to a cash flow to creditors of $22,525. All right, next let's look at the cash flow to stockholders. Another simple equation. We've got our cash flow to stockholders equals dividends minus net new equity all right, and it says in the problem that we issued $7,500 in new equity and we paid $9,000 in dividends. So we've got $9,000 minus $7,500. That's going to give us a cash flow to shareholders of $1,500. All right, we've got our operating cash flow to creditors, our cash flow to stockholders. So those are our answers for those parts right there. Next, we want to see if we increase our net fixed assets by $20,000, what the addition to net working capital is going to be. So first thing we need to do is we need to find our cash flow from assets. Okay, so that's going to be cash flow from assets is equal to cash flow from creditors plus cash flow to shareholders. One thing I want to highlight about this equation is notice we have assets, liabilities, and equity. Essentially, this is the same thing as the accounting equation that we have at the very beginning. It's just we are using our cash specifically. These are specifically talking about how we spend cash regarding those different areas. So we've got our cash flow from assets equals $22,525 plus $1,500. We're going to get a cash flow from assets of $24,025. We will now use that in our let's see, this is our other cash flow from assets equation where we use operating cash flow, change in fixed assets, and our cash flow from assets. We've got our cash flow from assets, and we're using our other equations. That's going to be our operating cash flow minus our net capital spending minus our change in net working capital. What we're actually finding here is the change in net working capital. So we've got our cash flow from assets, $24,025. We have our operating cash flow, which is $40,825. Our net capital spending is going to be our change in our net fixed assets plus our depreciation. So we've got $20,000 plus our $9,000 in depreciation. So let's see. Net capital spending equals change in net fixed assets plus depreciation, which is going to be $20,000 plus $9,000. And that is going to be $29,000. So we've got minus $29,000 minus our change in net working capital. Now, if we combine these, $24,025 equals, that's going to be $11,825 minus net working capital. The change in net working capital. We subtract 11,825 from both sides. That's going to give us 12,200 equals negative change in net working capital. Divide both sides by -1 to get rid of that negative sign. And we're going to have our change in net working capital is a negative $12,200. And that's all we have for today. I hope this helped you. Should be pretty helpful on homework or test. These equations specifically are pretty useful, and they'll be all the tools you need for solving problems related to using financial statements. Within finance, we're not really going to use these too much because a lot of this information can already be found on the financial statements, but we'll see in the next lesson how we can use financial statements to actually learn more about a company and evaluate a company's health. Thanks for watching, and we'll see you next time.